Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name is Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Joining me today is Nick Reece. Nick is the VP of Macro Research and Investment Strategy over at Merk Investments. He's got a lot of insights to share with us on both the stock market and the economy, so I'm really looking forward to picking his brain. But before we talk to Nick, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed lower this week. The Dow led, but it still fell about 1%. Now, the NASDAQ lagged by a notable margin, dropping about 6%. Taking a look at the Dow, it continues to be in the spotlight after having its best October ever. We reclaimed the 200-day moving average last Friday, but we couldn't hold above it this week. That's the fifth time this year that the Dow has been rejected at the 200-day moving average. Now, taking a quick look at the sector performance, only 3 of the 11 sectors closed higher. Energy led, gaining about 2.5%. On the other hand, tech and communications were the clear laggards, dropping more than 6.5%. Anyways, that's enough from me. Let's welcome Nick onto the show. All right, Nick, welcome to the show, and thank you for joining us today.
Thank you, Patrick. It's great to be with you.
So I know a lot of your work focuses more on the macro and some of the economic data out there, but I know you're also very technical. So how did you kind of get into technicals, and how do you think about that within your process?
Well, after college, graduating into the global financial crisis, I really fell in love with the investment approach of global macro and was engrossed in the Market Wizards books, which I'm sure many in your audience are familiar with. And one of the chapters that really stuck out to me was Marty Schwartz. And he has a great approach in terms of how he thinks about markets and trading, not just about the analysis, but about the psychology of the market, his own psychology, avoiding behavioral pitfalls, having a repeatable process, being focused on risk management. The same was true years later when I discovered Peter Brandt. And so I really have a great respect for these technical analysts that use technical analysis in their trading. And so I've tried to incorporate some of the lessons that I've learned from those intellectual heroes over the years.
Yeah, and I guess if you do put together this, macro view, you're still left with the issue of, well, how do I know if I'm wrong? How do I manage risk, right? And I guess technicals are the answer to that problem, right? Okay, I might have this macro view, but if price isn't kind of cooperating, that you can at least call it quits there, or at least something's not right.
Absolutely. It's a very disciplined approach to risk management because you think about from a fundamental perspective, well, if you liked it at $20 a share, you're going to love it at $10 a share, and that can be a very, very dangerous road to go down. And so technical analysis is self-correcting. I mean, momentum approaches are inherently self-correcting. And one of my favorite expressions from Peter Brandt is strong views weakly held. So, okay, I have a strong view about something, but if the market's not corroborating it, then that's it. I have to be humble enough to acknowledge that I've gotten either the idea wrong or the timing wrong or both. And you want to preserve capital and live to fight another day.
I keep hearing the stock market is not the economy, right? And, some of the optimists out there have pointed out that the stock market tends to bottom before the economic data does. And it's true, a lot of that economic data is lagging. But as someone who watches both the stock market and the economy, how do you kind of think about that relationship?
Well, it's a good point, and it's true that the stock market is not the economy. And we can observe that by noticing throughout history that there are bear markets without recessions and recessions without bear markets. But what I try to focus on is when those two things intersect and when you have a recession and a bear market coming together, which seems to be the situation that we are currently in. And part of the reason why it's relevant is because recession bear markets are significantly deeper historically than bear markets that occurred during ongoing economic expansions. in terms of the question of whether we're in a recession now, or the comment about the market typically bottoming before the economic data does, I certainly think that's true, that the market historically does and probably will in this case bottom before the economic data does. But we're still likely a ways away from that. It's pretty clear looking at the data that we are not currently in recession and might not enter a recession until maybe even the second half of 2023. Now, I do think a recession is more likely than not to occur between now and the end of next year. But it's important because the market typically bottoms in a recession rather than before a recession. And historically, the market is down in the first half and up in the second half. So you do want to be thinking from a contrarian standpoint once it is obvious that we are actually in a recession, which we're not in quite yet.
Yeah, and you answered my next question, which was, does it even matter if we're in a recession or not to the stock market? But if I'm understanding you correctly, you're basically saying that when you have a bear market coupled with a recession, it tends to be kind of more drawn out or more severe?
Yes, historically, it tends to be quite a bit deeper if we look at recession bear markets compared to bear markets that occur in ongoing expansion. So that's one of the reasons why it does matter and why I focus on the business cycle and regularly look at those leading economic indicators that can give us a good idea of whether the economy likely is going into recession. And so it's important to look at the leading indicators. That's probably the most valuable, but it's also worth looking at the coincident indicators. And over the past couple of years, I've done a pretty big deep dive into what defines a recession. And there was a debate about this earlier this year. And I'm certainly in the camp that would say it is not the 2 quarters definition. I mean, we can call that a technical recession, that's fine. But when we all look at charts, and when we look at charts that are published in the Wall Street Journal or USA Today that have shaded areas that are US recessions, those are defined by the NBER's Business Cycle Dating Committee, and they have a very specific definition that's pretty qualitative and leaves it open to some degree of interpretation, but it's a broad-based decline that lasts more than a few months, although there was an exception to that with COVID, which was only 2 months. And they specifically say what exactly they look at in terms of defining overall economic activity. And I track those 6 indicators that they specifically mention very closely. And 6 out of 6 of them moved higher on the last reading, and 5 out of 6 of them have made new post-COVID highs. That's through the end of September. So that tells me that the U.S. economy really has not been in recession so far and is not necessarily that close to going in recession.
Yeah, I think what you said earlier, basically about how bear markets tend to end once we're in a recession, I think that's a really interesting point. It's almost like just call it already so that we can maybe have the hopes of bottoming, right?
Certainly, I think the announcement or the if it's apparent in the data, as I was saying, if it becomes apparent in the data that we are in a recession, that's a very good contrarian signal to be constructive on the equity market. And one example of that would be if we see a significant move higher in the U3 unemployment rate off of the cycle low. That's a pretty good indicator, actually, in terms of being in a recession, but it's also a pretty good indicator that by the time we get that data, which comes out with a little bit of a lag, historically, it works out pretty well to be thinking from a contrarian perspective and be constructive on the market.
Yeah, and for the longest time, the 2 and 10 yield curve that inverted months ago, but for the longest time, the counterpoint to that was, well, the 3-month 10-year yield curve hasn't inverted yet, and that's kind of the one that has the better track record for predicting recessions. But that one inverted too, like last week, right? So how are you thinking about that?
Absolutely. That was one of the missing pieces on the recession warning sign checklist that I maintain. And we have gotten that. And so we had it into the month end of October, and we have it. So we have seen that. Now, you typically want to see that for some amount. You want to get some amount of depth and duration on that indicator in order to, consider that to be a valid signal. We've had it historically, as far as the data goes back, it's always happened prior to recessions, but there have been a couple of head fakes. In other words, you can get some false positives. We haven't had any false negatives in the sense that we've never gone into a recession without seeing the prior inversion of that indicator. And historically, it's about a 6 to 18 month lead from the initial inversion of the 10-year 3 month to the front edge of the subsequent recession, which is why I say I wouldn't be surprised if this coming recession, if it indeed materializes, doesn't start until the middle or later part of next year.
I think that's a really interesting point. But let's dive into the S&P 500 a little more. So here we are, this has been the worst year so far. We got 2 months left to go, but worst year since 2008. The S&P 500 is down about 22%, give or take. But you've been sharing this chart since the very beginning of the year, saying that, these average years, you hear people talk about, oh, the S&P 500 on average does about call it 10%, 8%, whatever it is, per year. But that figure is kind of just a mirage. You don't actually get average years very often. You tend to see really big years or really bad years. Is that right?
That's right. Yeah. So I went back, and for the data, as far as the data goes back for the S&P, which is to the late 1920s, only 17% of the time was the calendar year return between 0 and 10%, which you kind of think of as being an average year. And the sell side analysts, when they put together their following year forecasts, typically the central tendency of those forecasts is right around 6, 7, 8%, which is the historical average. And yet it's very, very rare that you actually get a year like that. So it's a pretty good bet that that's going to be wrong, and it's either going to be higher or lower. Most of the time it's higher. 52% of the time the calendar year return is above 10%, which I think is an interesting statistic. Obviously, in those exceptional years that are down, which we're likely in now, it can be it can be deeply negative. It's rare to have these years, and then typically they're followed by pretty strong returns the following year.
Yeah, and I know you kind of look at the bigger picture trends at play, but if you're looking at the S&P 500 technicals in kind of the intermediate term, what are some of the levels and indicators that you're watching, and what would it take to get you bullish?
Yeah, one of the frameworks. I think we have to always update our outlook as incoming data becomes available. So that's a big part of the process. But just to talk about levels for a minute, I would say that, historically, the median bear market decline is 34%. And so that 3,200 level on the S&P represents about a 35% drawdown. And that's a number that I'm focused on. And I think a number of other analysts have talked about as well. It does coincide with the Fibonacci level right around there too. But I think it's interesting that that's the median point of bear market decline. So in other words, half of bear markets, and I'm defining a bear market here in the generally accepted way, which is a drawdown that's 20% or more. Half of them historically have been between 20% and 35%, and half of them have been deeper than that. So I think if we're down 35%, it's just a very good bet historically that you can be starting to accumulate from there, assuming that you're willing to stomach being wrong for a little while. Now, I don't know if this bear market is going to get to that depth. Obviously, we can't say that for sure, but it's just a level that I have in mind and that I'm watching.
Yeah, it sounds like in terms of other historical drawdowns, this one's kind of somewhere in between a mild bear right now and some of those more severe ones that you mentioned, like 33% or more. Is that kind of sound right?
Yeah, in fact, this is I do try to think from a historical perspective, at least as one of the lenses through which I look at markets. And one of the analogs, and this is a hard time to find a good analog for, but I think there are a couple that are worthwhile. But let me hone in on one right now, which is the late 1940s. There was a big post-World War II inflation spike and a market decline that was associated, I would say, with that spike in inflation. Inflation typically is not good for either the stock or bond market. And so we had this initial decline in the market based on this post-war inflation spike, which is somewhat analogous to the current situation in terms of clearly a big supply shock with the reorientation of the economy towards the war effort and then reorienting it towards a consumer economy. There were other factors as well, but in any case, the market had an initial decline and then kind of chopped sideways for a while and then made a sort of a final move lower into a mild recession that didn't start until 1948. So that analog I have in mind, and the market does seem to be tracking it pretty closely. And so I think that's one where it's kind of a mixed bag. It's somewhere in between. I'm really not at this point expecting this to be what I would call a major bear market like that of the early 2000s or the Great Recession, global financial crisis.
Yeah, and I love those analogies because I think so many of us are conditioned to the bull market of the last decade where we've had these V-shaped recoveries. And sometimes these bear markets take time to recover, right? They don't just necessarily recover it. It's these bottoms aren't just an event, it's more kind of a process. Is that right?
Absolutely. And I think one of the takeaways is that we might not be that far from the recent lows that we saw, which were down 25%, we might not be, those levels might be not that far above the ultimate lows. I mean, okay, let's say 35% is the ultimate low. It's going to feel very scary on the way there, but 35%, 25%, at the end of the day, that's not a huge difference, but it might not occur until the second half of next year. So I would say there's probably likely more potential for more time in this bear market than there is for depth off the recent lows.
So let's move on to this table you have here. We used this table for chart of the day a couple months ago, and it reminded me of that Paul Tudor Jones quote where he said, there's no training, classroom, or otherwise that can prepare you to trade the last third of a move, whether it's a bull market or a bear market. And you basically quantified what Paul Tudor Jones was saying there. I don't know if you did that on purpose or not, but your point here was basically that the last third of a bear market tends to be much more severe than either of the first two. In fact, on average, the last third is twice as bad as the first two combined. And I was kind of interested to see where we were at with that. So I basically took the extent of the decline or the duration of the decline, and I divided it up into thirds. I think each third is like 65 trading days or something like that. But I found that basically we fell about 6.5% initially. Then the second third was the worst, fell about 14%. And then that third, if October was the low, which of course we're not going to know in hindsight, but I think it's still a good exercise. That third wasn't that severe. It's not in line with how you typically see bear markets end, with that kind of capitulative third leg lower. So, how are you kind of thinking about this one? Do you think that we need to see that final puke?
I suspect that we will. I do suspect that we haven't seen the ultimate lows for this bear market. And I like that you updated the analysis or did it to the recent low to measure the numbers, because one of the things in the table in the study that I put together was not just the degree of those different thirds, and those are thirds of duration, as you can tell from the chart that you've recreated. But I think the other statistic there that was interesting is that 11 out of 16 times it was it had the biggest decline in that final third of time duration. And so based on the study that you've replicating this for the current situation, it would suggest that it's inconsistent with what we historically see, and therefore probably not the ultimate low. And I think that's a reasonable conclusion. I mean, of course, none of this is, physics. We're not measuring the return of Halley's Comet here, but we try to get an edge on things by looking at history.
Yeah, and I should warn our viewers, definitely go double check my work on that if you're interested. I did it kind of quick. But anyway, let's move on to sentiment. I want to get your take there. If you look at something like the AAII sentiment survey, you're still near levels of extreme bearishness, which should be bullish from a contrarian point of view. But, as my previous guest had said, Walter Deemer, he said, if you need an indicator to tell you that sentiment's at an extreme, it's probably not. And of course, by that, he means that sentiment's only really useful when it's at an extreme. And it's usually so glaringly obvious when it's at that extreme. So yeah, what is your read on sentiment here? Do you think it's even an important piece of the puzzle right now?
I think in general, sentiment's an important piece of the puzzle and very much worth trying to quantify and track. What's interesting about the AAII survey, and maybe its best feature is the history of the data. It goes back, through a reasonable number of cycles. But what you'll notice is that sentiment actually was very weak in the early part of 2008. And of course, the market didn't bottom until a year later. And so the fact that we do see weak sentiment is, I would say, maybe a necessary but not sufficient condition for a bottom. So it's something to be cautious about in terms of how much we want to read into it. But it is noteworthy that we do have weak sentiment. And I think generally speaking in my framework, which is a contrarian one for this type of data, of course, it is constructive, but it's not enough to be constructive on the market. And this is just one way of quantifying it. There are other surveys, there are other ways of thinking about it as well, and looking at implied volatility and options and things like that as well, which is worth doing. But then on top of that, there's just kind of the anecdotal data that's hard to quantify, which is sort of what you're seeing in terms of market commentary, how negative that is, how pessimistic the financial media is, what the headlines are. And I don't think we're at any kind of max pessimism right now when I think about it that way. I do think in June, the narrative had gotten too far carried away in terms of recession talk when the data was pretty clear that the US economy was not in a recession and not imminently going to go into recession back in June. So I think at that time, it was easier to say, okay, this sentiment has gotten, carried away to the sort of on the pessimistic side. And one of the things that I wrote is that it wouldn't, when pessimism is this extremely negative, it doesn't take that much for the glass to go from half empty to half full. And indeed, we saw, kind of a relief rally from the middle of June to middle of August.
Yeah, and you brought along this anatomy of a bubble chart, and I've had this one on the show before, and I always like asking guests, if you had to pick, where do you kind of think the crowd sentiment is right now within this anatomy of a bubble chart?
Yeah, I like to map this onto what's happening in the IPO index, the ARK ETF. I think that's where there really was a speculative mania, speculative bubble, and that process is now unwinding. So with the way that this chart is labeled, I would say we're still in the fear and capitulation phase. I don't think we're quite in that final despair yet. There's a chart where I map the IPO index onto the NASDAQ back in the early 2000s, and it follows that really nicely. And that suggests that there's a little bit more, both in terms of depth and duration.
Yeah, I mean, you use the IPO index there, but I was telling you earlier, you could have used ARK, and that chart probably would have looked exactly the same. And I'm sure there's probably a lot of overlap between some of the components in the IPO index and some of the ARK components, right?
And it's a classic, this chart does a nice job. I was looking at it earlier today again, and it has this stealth phase and awareness phase in the early parts. And I would say that, tech in the early part of the 2010s was in that stealth phase and awareness phase. And then it becomes so obvious that you get this supply and demand reaction where there's so much demand to invest in these young pre-IPO technology companies. And we saw that happening with a lot of really big hedge funds, coming in a really massive way into the private markets. And then conversely, on the supply side, there are a lot of entrepreneurs saying, hey, let me try to put together a business plan and get some traction and monetize it with a huge multiple that the market's willing to pay.
Yeah, and then you had the Tiger Globals of the world and the SoftBanks out there ready to invest in those business models. And
exactly,
that kind of created a little speculative fever in the private markets. And then they had to bring it on to the public markets by IPOing, right?
Yeah, and I think in 2020, we just saw this massive wave of IPOs. It dwarfed, 1999, 2000. And of course, the SPAC phenomenon was a big part of that, and kind of classic, I think, if we think about, kind of what that's symbolized in terms of the mania. So I think 2020 was that kind of greed phase on this diagram. And then that whole segment of the market peaked all the way back in February of 2021. And there was still a huge number of IPOs in 2021. So it was just that classic supply and demand shift that overwhelmed the market. And then you saw those prices and valuations declining.
Yeah. And I'm glad we somehow ended up at tech here, because that's something else I wanted to talk about. This mega cap tech and growth underperformance. We kind of have this like bifurcated market right now, right? Where you have some of the past leaders, like the mega cap growth and tech, your big Facebooks, Amazons, Microsofts out there. They are really taking it on the chin the last few weeks and really all year. And on the other hand, value still shining. that's not really anything new. We've seen value outperforming growth all year, but it's kind of just reasserting itself. But at the same time, I say it's nothing new, but I think we're still far from consensus that value is kind of the place to be, right? So, what do you make of this mega cap growth underperformance, and while value and small caps kind of take the lead over those former leaders?
Yeah, I think that growth, the style factor of growth, which is a lot of what the tech sector is and the consumer discretionary sector is very influenced by what's happening with interest rates out the curve. Those are long duration cash flows from those companies. I mean, they're high growth companies, and even these mega caps that are actually free cash flow positive, have a lot of growth in profits priced into them. And so as the discount rate goes up, as we see the 10-year nominal rate making new cycle highs, and not just the nominal rates, but I'd argue more importantly, real interest rates, the yield to maturity on a 10-year TIPS bond, for example, is typically the way we look at that. There's a pretty strong correlation there to the forward multiple on growth stocks. And so as nominal and real interest rates have risen, that's punished those growth companies because it's brought back those future cash flows to a lower present value. It's classic corporate finance 101 discounted cash flow analysis, which is a pretty good way to think about these growth companies and these technology companies. And so that's really been the dynamic at work. And meanwhile, a lot of value companies are very cash flow positive, and they don't have a lot of necessarily growth priced into those cash flows. So there's a relative, they get relatively less punished in a rising interest rate environment. And then of course, some of those companies, some of those sectors like energy has been an outstanding performer. It's actually been positive during these drawdown phases that we've seen so far this year. And with a lot of value, a lot of the value style factor in that sector, of course, that's been a big contributing factor.
Yeah, and one of the difficulties of even talking about this topic is there's a lot of different ways to look at it, right? We could talk about growth versus value, or you look at something like the NASDAQ versus the Dow, and that thing's gone like parabolic in the last few weeks. And it's kind of showing a similar theme. And if I'm hearing you correctly, it sounds like it's really interest rates behind that. That's kind of driving that, right?
It is, and behind the interest rates is of course inflation. So that's really the big macro variable is inflation, and then the Fed's reaction to inflation, which has been driving interest rates. But I would say, the Fed really only controls interest rates on the shorter end of the curve. So the fact that the 10-year has moved up as much as it has does suggest that the U.S. economy remains in expansion and remains relatively resilient. It's one of the reasons that the 10-year versus the 3-month was so stubborn to invert.
Well, let me ask you this. So last week on the show, I had Walter Deemer on, as I mentioned, and he said something that really stuck with me, which is new bull markets often feature new leaders. So do you think we could have a scenario in the next year or two where you have a new bull market, but it's just not the leaders that we're used to leading it? It's not the FANG names. You know what I mean?
I think that's more likely than not. If you look historically, it's very common that you have new leadership coming out of a new cycle. And even Jesse Livermore talked about that in Reminiscences of a Stock Operator. So it's a very, very common feature. And we see that since we've had sector data, which is only going back to the mid 1990s, we've observed that. One exception was the COVID bear market and COVID recession, which was such an exogenous shock that it almost needs to be classified differently than a normal cycle. And we did not see a change in leadership. Now, also part of that you could say is the nature of that recession, the nature of that bear market, and with the lockdowns, to some extent that benefited those technology companies. So that's certainly part of that story. But it was noteworthy to me that we did not see leadership change in that bear market and in that recession. But now, what I'm observing is more of what I would say is an organic, more of an endogenous bear market and business cycle going into a likely recession. And so I would expect to see new leadership coming out of it. And to make another historical parallel, if we go back to the early 2000s, we know very well that the NASDAQ, which I would call kind of large cap growth, went through this big boom and bust. But really noteworthy to me was that small cap value, which is of course the opposite of large cap growth, not only outperformed on a relative basis, but was positive in absolute terms throughout that whole dot-com bust. And so it's important to remember that just because there's a bubble in one segment of the market doesn't mean that the entire market is uninvestable, or there isn't some segment of the market that isn't going to be providing either attractive relative returns or even positive absolute returns.
Yeah, I liked what you said there about COVID being kind of a very unique bear market. I have trouble even calling it a bear market. It's more like a hiccup to me, a very severe hiccup. I mean, it's 33% drawdown. I guess that's nothing to scoff at, but it was just so rapid, and that V-shaped recovery. I don't think anyone I was talking to at the time, I don't think anyone expected that.
Yeah, absolutely. And I did a study earlier in the year, and I wrote this up a little bit, that if you go back to the day after the ultimate bear market low, not just for the COVID crash, but for the '09 low and the others before that, I mean, the market rallies so strongly off of the bottom. And that's to the point about sentiment, is that, who would have thought that March 23rd, 2020 was going to be the ultimate low? And I mean, the market just took off something like 10% the next day and never looked back. So it's important to keep that in mind when we think about, okay, well, if the ultimate drawdown is going to be 35%, let's not forget that the day after that 35% low, market could be up 5 to 10%.
Yeah, and just to put a counter to that, that was an extraordinary scenario because you did have the Fed easing there, or just pumping massive stimulus into the economy, and now we don't, right? So it kind of gets back to that whole thing. Should we be expecting this event for the bottom, or more of a process, right?
Well, I fully agree that the Fed is not on your side in this market right now. And the real question is, I mean, if the Fed pivot could be bullish for the market if there's a soft landing. But if there's not a soft landing and we are going into recession, and I suspect that's more likely to be the case. In other words, the Fed's going to overdo it. They may have already overdone it. And so by the time they pivot, it's actually not bullish for the market. The market may not bottom until, well after the Fed starts cutting rates.
Yeah. Well, listen, we're running out of time, so I want to try to wrap it up. But before you go, I want to get your take on rates and the dollar. I know you touched on rates a little bit, but we've been calling them the wrecking ball because they've been putting pressure on stocks, and they seem to be moving up together. So my question is, what's driving that correlation between rates and the dollar? Why are they moving together, moving higher together? Is there something underlying that, like structurally?
Well, interest rate differentials are often a big driver of exchange rates. And so that's not too surprising to see that relationship. One of the things I hone in on, though, is the high yield credit spread relative to the US dollar. And the US dollar is a little bit unique when we think about currencies because it is the de facto world reserve currency. And part of what that means is that a lot of companies, a lot of entities, a lot of countries outside of the US actually borrow in US dollars. And so the dollar tends to be bid when you're in a global growth slowdown, which we're clearly in right now. And what happens is that when in a global growth slowdown, you have lower revenue growth. And so you've got all of these companies that have borrowed in dollars that are now having a harder time financing that debt. And you've got credit spreads widening. So it's more expensive to finance that dollar denominated debt. And so it's what some people call and what's referred to as a global dollar short squeeze. So that, I think, is the dynamic that's really pushing the dollar at this stage. And I would expect the path of least resistance to be higher until we are actually sort of confirmed to be in a global recession. And I think a global recession or a European recession is likely to happen sooner than a US recession. And that's around the time where I would expect the dollar to peak. And it could be a major inflection point for the dollar that we then see sort of a secular bear market on the other side of that for the next 5 to 10 years.
Yeah, I mean, look how tight that correlation is between high yield spreads and the dollar. It's really just like step for step, basically. So do you think we'll likely see them peak at the same time, like together?
Yeah, I do think they will. I do think they will likely peak around the same time. The other thing that I look at is uptake on the Fed's dollar swap lines to foreign central banks. And so when you have this global dollar short squeeze, this global dollar shortage is one way to think about it as well. typically what happens is that we see cross-currency basis widen, which is measured as the difference between benchmark risk-free rates and the interest rate differential that's priced into the forward points of exchange rate forward curves. And we've started to see that widen. And if we see it widen more, we're probably going to see more meaningful uptake on these Fed swap lines. And that typically will, and historically the last 2 times it's been used, put a top into the dollar. So that's sort of the playbook that I'm working off for thinking about this dollar peak is probably going to peak around the time that the high yield credit spreads peak, which is probably going to be in a recession and maybe in the early part of a recession, as well as when we see those cross-currency basis spreads widen, and then the policy reaction of borrowing dollars from the Fed to alleviate that.
Yeah, and I don't want to put words in your mouth, but it kind of sounds like you're thinking we might be in the later innings, but what that final third, to bring it back to that, what that final third of the move might look like, it could be a real ripper. It could be a parabolic move, end in fireworks before we see the end, right?
Absolutely. And we saw that in the COVID crisis as well, which clearly strained, global supply lines and global financing. And you saw the dollar kind of shoot higher very, very sharply. I mean, that was an incredible amount of volatility in G10 currencies, which typically, we're talking about liquid developed markets. You typically don't see that. So we really did see some fireworks during that COVID crisis. But, it's just so interesting that these Fed swap lines really did work to alleviate that stress. And so these firefighting tools that the Fed has developed, especially, cutting their teeth in the 08 crisis when a lot of these tools came into existence and expanding it even more during the COVID crisis. I mean, there's a lot, and these policymakers can have a big impact on markets. So if we do see, like I said, I think the path of least resistance is higher, but if we do see that sharp move up, I think that really could be very close to the top.
I see. Well, listen, we got to wrap it up now. But before I let you go, where can our viewers find more of your work if they're interested?
Yeah, the best place to go is just to follow me on Twitter, which is @NicholasTReece. And I'd welcome anybody to message me there, and happy to stay in touch with the community.
Good stuff. Well, thank you again for coming on, and I'd love to do this again sometime.
Thank you, Patrick. I really appreciate it.
Awesome. Have a great weekend.
You too.
Bye. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.